Welcome back to the deep dive. If you've ever wondered what it looks like when a massive global corporation decides to perform some pretty serious internal restructuring while, navigating a choppy economy, well, this deep dive is definitely for you.
Yeah.
Today, we're plunging into the recent financial filings and strategic roadmap of ON Semiconductor Corporation. We're really looking at a company experiencing, well, controlled chaos seems about right.
That's a good way to put it. Our mission today is pretty crucial. We need to analyze this stark contradiction in their late 2025 reporting.
Right.
Because on one hand, you see these massive financial hits, some from market slowdowns, sure, but also a lot from, like you said, self-inflicted internal surgery. But then on the other hand, they're making these really aggressive multi-million-dollar bets on their long-term future. And it's all centered on these high-growth areas, specifically automotive power and cutting-edge AI data centers.
So we're not just reading quarterly numbers here. We're trying to figure out the cost and maybe the vision behind what looks like a pretty radical corporate pivot.
Exactly.
We're going from the Q3 reality check through this really costly 2025 manufacturing realignment they announced, and then straight into the big technology partnerships that seem to define their future.
Sounds like a plan.
Okay, so let's start with that financial reality check. What made this pivot feel so necessary? Q3 2025.
Yeah, it was undeniably a rough quarter compared to the year before. If you just look at the top line, year over year.
Okay, 12% down.
Which is significant, don't get me wrong.
Yeah.
But the real story, I think, is what happened to profitability.
Yeah, that's the part that needs unpacking. Net income. I mean,
Right.
it fell from over $400 million in Q3 2024 down to, what was it, $255 million this quarter?
That's right, a big drop.
But the number that really jumped out, signaling maybe severe stress, was the gross margin. It fell sharply, right? From 45.4% down to 37.9%.
Absolutely.
Yeah.
That margin compression is really the key takeaway here. I mean, a 12% drop in revenue usually doesn't translate into an almost 8-point drop in gross margin unless something else is going on.
Like what?
Well, like severe pricing pressure across the board maybe, or perhaps the early stages of these inventory write-downs starting to hit their income statement. This kind of margin pressure feels disproportionate to just the sales drop.
And was this pain felt evenly across their different business segments? They've got the Power Solutions, PSG, then Analog and Mixed Signal, AMG, and Intelligent Sensing, ISG.
Not at all. It was quite uneven, actually.
Yeah.
PSG, their core Power Solutions group, saw revenue decrease by about 11%. AMG, the Analog group, saw a pretty similar 11% decline.
Okay, so those drops are painful, but maybe kind of predictable given the market headwinds?
You could argue that, yeah. Painful, but maybe within expectations for slowdown.
But here's where it gets really interesting with ISG.
Exactly. The Intelligent Sensing Group, ISG, experienced the steepest decline by far, down approximately 18%.
18%, wow.
Yeah. And when you roll all that up, the cumulative effect was this massive reduction in gross profit, down over $212 million, or a 27% year-over-year drop.
Oof. Okay, that tells a story of, huge volume declines combined with maybe a poor product mix or pricing pressure.
It does. The filings even break down that reduction a bit. They say the sales volume decline alone negatively impacted gross profit by nearly $190 million.
Okay.
So this kind of financial pressure is really what compels a company to make these kinds of radical strategic shifts, which, brings us neatly to the internal surgery they just performed.
Right, because this wasn't just them reacting passively, was it? The company actively decided to inflict some serious short-term financial pain via this 2025 Manufacturing Realignment Program. This was a deliberate cost.
This is critical context, absolutely. For the 9 months ending in October 2025, the total charge they recorded for restructuring, asset impairments, and other net, well, it skyrocketed to over $600 million.
$600 million?
Yeah. That's an increase of over $500 million compared to the same period the year before. This isn't just, typical quarterly expense. This is a massive internal investment, really, in future efficiency.
And we can't just gloss over the human element here. They let go of about 2,400 employees globally as part of this program. That's a huge, and I imagine pretty painful operational upheaval.
It is, absolutely. And the direct financial cost of that specific piece, the severance charges recognized during those 9 months, was nearly $66 million.
Okay.
It just signals that the company is willing to endure significant organizational pain to chase what they believe is a higher margin future. But interestingly, the largest chunk of that $608 million charge wasn't actually cash spent on severance. It was non-cash asset write-downs.
Okay, tell us more about that. What does nearly $500 million in non-cash charges for asset write-downs actually mean for someone not deep in finance?
Right. Well, think of it maybe like a homeowner throwing out all their old, maybe energy-guzzling appliances, and maybe even tearing down their old garage, all to make room for a brand new, extremely expensive smart home system that's focused entirely on energy efficiency.
Okay, I get that analogy.
So they recorded these non-cash charges, $487.9 million, related mostly to manufacturing equipment, assets that are now classified as held for sale. They're essentially writing off the book value of old manufacturing lines
Why?
because those lines are either too inefficient now, or maybe they're designed to build products that just don't fit their new hyper-focused, high-margin strategic vision anymore.
And you said this ties back directly to that struggling segment ISG, the Intelligent Sensing Group. There was a huge inventory write-down there, too.
That's where the strategy really becomes crystal clear, I think. The company recorded almost $236 million related to excess and obsolete inventory charges overall.
Okay.
But crucially, the filing states that over $230 million of that relates specifically to work-in-progress inventory within the ISG segment.
Wow, almost all of it.
Exactly.
Yeah.
So this wasn't just about consolidating physical factories. This was a sharp, very expensive change in business strategy. They're effectively writing off inventory, stuff already being made, that just didn't fit the new path forward.
It looks like they're cutting the cord pretty decisively on some legacy sensor business to shift those resources elsewhere.
So, okay, summing up this part.
Yeah.
ON Semi basically absorbed hundreds of millions of dollars in charges, restructuring, severance, asset write-downs, inventory write-offs, all to kind of clean house and realign their capacity. They're clearly betting that this short-term pain will lead to massive long-term dominance,
That seems to be the gamble, yes.
which naturally leads us into where they are pouring that focused capital now.
Right.
Let's talk about the strategic growth anchors.
Right. And if we connect this to the bigger picture, this entire realignment effort seems designed to free up resources and sharpen their focus on intelligent power solutions, primarily within that PSG, the Power Solutions Group, domain.
They seem to be doubling down hard on two major future sectors that absolutely require extreme power efficiency: automotive electrification and next-generation AI data centers.
Starting with automotive, then, they're focusing heavily on something called EliteSiC. That's their silicon carbide technology, right? And they recently partnered with Schaeffler on a new PHEV platform using it.
That's right. The Schaeffler partnership is one piece. But maybe the more crucial evidence of this big bet is the cash they actually spent. Remember back in January 2025, they spent nearly $119 million to acquire the JFIT technology business from Qorvo US Inc.
Ah, right, the acquisition.
And that technology is specifically intended to significantly complement their existing EliteSiC portfolio. They're buying expertise in IP.
Okay, so they're focusing intensely on silicon carbide, SiC. But, that material, SiC, seems to be increasingly available from competitors, too. Given the massive financial hit they just took to pivot towards it, how sure can they be that these acquisitions and partnerships will really give them a proprietary edge? Or are they maybe just positioning themselves to sell high-volume chips into what might become a more competitive SiC market?
That's the essential question, isn't it? And the reason SiC is probably worth a $119 million bet is tied directly to performance, especially at the high end.
How so?
Well, SiC is crucial because, unlike traditional silicon, it handles extremely high voltage with far, far less energy lost as heat. You can think of it maybe as the difference between, I don't know, driving a regular passenger car versus a Formula One racer, but for electricity flow.
Okay. Much higher performance, less waste.
It's exactly. This massive reduction in heat loss and the resulting increase in power density, how much power you can handle in a small space, is absolutely essential for things like rapidly charging electric vehicles.
Yeah.
And crucially, for handling the absolutely colossal power demands of these massive AI server racks, they seem to be betting on mastering the highest performing, maybe the most difficult to manufacture components within that SiC space.
Okay, that makes perfect sense for the high efficiency demands of EVs. Now let's look at that other massive growth vector you mentioned, AI and the data centers that house all that computational power.
Exactly. Because power efficiency is arguably everything in AI infrastructure.
Yeah.
And here they've partnered with NVIDIA. The goal: to accelerate the transition to 800 VDC power solutions for these next-gen data centers.
800-volt DC power solutions. Why is that specific voltage, 800 VDC, so significant for an AI data center?
Well, moving to these higher voltage DC architectures is a really key strategic step for data centers. It's kind of like upgrading a city's water pipes from small ones to huge mains.
Yeah.
It allows you to deliver far more power through the same or even less physical space, and you do it with dramatically less energy loss along the way, which also means less heat generated.
Ah, less heat is critical in a data center.
Absolutely critical.
Yeah.
So that ability to deliver dense, cool power right to the GPU clusters is a massive competitive advantage for the data center operators. And ON Semi reinforced this strategy with another acquisition. They bought VCore power technology from a company called ON Semiconductor. That deal could be worth up to $144 million, depending on milestones.
And that was specifically for AI data centers.
Yes, the announcement specifically framed it as strengthening their leadership in the AI data center power space.
Okay, so they are truly stacking these acquisitions, Qorvo's SICK JFET, Aura's vCore, and combining them with internal pivots like the restructuring, all to create this single, powerful, intelligent power portfolio. And it's targeted right at the most difficult, highest value challenges in both automotive and AI.
That certainly seems to be the strategy.
It's clear they have a vision, maybe a costly one initially. But how does all this turbulence translate into their immediate expectations for shareholders? Let's look at the Q4 2025 guidance they gave.
Right. The forward guidance suggests they expect some stabilization after the major surgery of Q3. For Q4 2025, they're guiding revenue to be roughly flat compared to Q3, somewhere in the range of $1,480 million to under $180 million.
Okay, holding steady on revenue.
But crucially, look at the non-GAAP gross margin. It's projected to stabilize between 37.0% and 39.0%.
Oh, okay.
That expected margin range, relatively firm after the big Q3 drop, seems to confirm that they expect the positive impact of those aggressive cost controls and maybe some of the restructuring benefits to start kicking in.
So after taking that big hit in Q3, they expect margins to kind of hold the line through the end of the year.
Precisely. And non-GAAP EPS is guided between $0.57 and 67 cents, with operating expenses also expected to be pretty tightly managed. They seem to be focusing maybe maniacally on keeping those costs in line while they execute these big strategic pivots.
And it seems they were doing all this, the restructuring, the acquisitions from a position of relative strength when it comes to cash reserves, right? Even while funding these huge costs.
They absolutely were. Their balance sheet looks strong. They reported pretty solid liquidity, with cash and short-term investments totaling approximately $2.9 billion as of October 3, 2025.
Nearly $3 billion in cash.
Yeah. That gives them the crucial runway, the breathing room, needed to execute these ambitious strategic investments without facing immediate financial stress or having to take on excessive debt, presumably.
And despite the Q3 earnings pain and all the restructuring noise, they continued to return capital to shareholders pretty aggressively through buybacks, didn't they? Which usually suggests management confidence in the future stock price.
That's a really key signal for listeners, I think. They repurchased 6.1 million shares in Q3 2025 alone, spending over $328 million to do it. And with roughly $861 million still authorized for buybacks through the end of December 2025, management is clearly sending a message. They seem to believe the stock is perhaps undervalued because of the short-term financial chaos, and they expect this strategic pivot to eventually pay off quite handsomely.
Okay. And finally, we should probably briefly mention that their sustainability commitment seems kind of woven into this whole strategy, especially since the big focus is on energy efficiency, right?
It is definitely part of the narrative they're presenting. They maintain this net zero 2040 commitment, and they point to near-term targets validated by the Science-Based Targets Initiative, or SBTI, things like targeting a 58.8% reduction of Scope 1 and 2 emissions by 2034.
Right.
So efficiency isn't just, a nice-to-have marketing point. It's actually core to the high-value business they're pivoting the entire company toward.
That summarizes our deep dive perfectly, I think. We've got ON Semi, a company absorbing really major short-term costs hundreds of millions in restructuring, significant workforce reductions, big inventory write-downs, all seemingly to aggressively pivot toward these long-term, high-growth, and hopefully high-margin markets. They're firmly anchoring their future in things like EliteSiC for PAGVs, partnering with foes like Schaeffler, and these high-voltage power solutions for AI data centers, working alongside giants like NVIDIA.
Yeah, it's a bold move.
Yeah.
And it raises, I think, an important question for you, the listener, to consider. This whole realignment effort dramatically shifted capital resources, internal capabilities, everything towards high and intelligent power. So given the massive cost, the disruption, the
Yeah.
clear urgency behind this 2025 Manufacturing Realignment Program, what major technological breakthroughs, maybe in power efficiency or perhaps even using next-generation materials beyond just the current cycle technology they're betting on now? What breakthroughs will be necessary for onsemi to truly justify this upheaval? And critically, to maintain a leadership position in, say, 2027 and beyond, the price they paid suggests they believe semi is just the beginning of something bigger.
Mm-hmm. That's a great challenge to consider as they and we watch them move forward. Thanks for tuning to the Deep Dive. We'll be back next time with more crucial nuggets of knowledge.